Hey, what's up, good people? How you doing? Welcome back to Stock Up with Larry Jones. You know I'm going to ask, so just go ahead and do it. Go ahead and hit that like, that subscribe, and that notification bell, right? If you're not getting your notifications, make sure you check that it is checked for all right? If you've been rolling with me for a while, continue to hit the like button. Never fall for spam. I never ask you for money, crypto, talk about a broker, or WhatsApp. It's spam. We're going to talk about where the market is today, okay? What's going on in the market and where we think we are, right? So a lot of us, been hearing about these rate hikes. The thing that's weighing on the market the most is the rate hikes. It's not Omicron, it's not anything, right? So the Fed interest rates, inflation is high. The Fed have to combat the inflation. There's two things: the balance in the book, which is the buyback of the bonds, and rate hikes. And what I mean by rate hikes, the amount for you to borrow money is going to cost more. So the interest rate hikes, okay? And so you've been hearing these crazy numbers. There've been numbers thrown out. Are they going to raise it 3 times? Are they going to raise it 5 times? Are they going to raise it 7 times this year alone? It all depends on what's going to happen to inflation. All of this affects your money in the stock market and crypto, okay? So all we can do is speculate. So if they say 4 times and inflation starts to flatten out, they may reduce that to 3 times. I'm sorry I'm talking like this, but I'm getting a crown for the root canal I had a couple of days ago, and I literally just left the dentist, and I'm still numb. But I got to keep the family fed. So I'm going to play this video of what some of these smarter people than all of us YouTubers are. And we're going to discuss this because this may help you in some of your buying decisions. Okay, let's check it out.
In the meantime, Fed watchers have been raising their outlook for Fed tightening, forecasting as many as 5 rate hikes for this year. But some new survey data says cooler heads may prevail. Steve Leisman joins us right now with more, and this is the raging debate that's probably driving the markets right now, Steve.
Yeah, and here's another entry in it, our CNBC Flash Fed survey, Becky. We did it after the Fed meeting to see if the outlook of our respondents changed. Finds they're not as hawkish on rates as market pricing for 5 or more rates, but they are hawkish in another area. We'll get to that in a second. First, among the 38 respondents, the average looks for 3.7 hikes this year. What's that tell you? It shows that 3 hikes are built in, and they're debating a 4th, not a 5th, 6th, or 7th. The average fund rate seen at just 1% this year. Next year, another 3 hikes are built in, with the funds rate rising to 1.8%. Only one respondent sees 5 hikes, and there's little support for a 50 basis point rate hike in March. Douglas Gordon, managing director at Russell Investment, says, while we think that the FOMC's hawkish pivot will sustain hiking through the first half of 2022, we also anticipate that this policy action and its efficacy relative to inflation will allow for a softening of the hawkish stance towards the end and into 2023, towards year end, that is. The outlook for inflation, now running at 7% year over year, is for a decline to 4.2% this year, 2.9 by end of 2023. So the more dovish outlook on rates comes, at least in part, with a belief inflation will come down. But there's another reason. Respondents are looking for more balance sheet runoff than the prior survey. Take a look here. The average looks for the balance sheet to begin running off in July, which was the same, and a total $460 billion this year, up from $380 in the forecast before the meeting. That grows to $930 billion next year, up from $860, and $2.5 trillion in total runoff over 2 years and 8 months. By the way, that total is also lower. It had been 2.8 in the prior survey. Okay, the Fed may eventually prove the more hawkish view on rates to be correct, but it's also possible the Fed will do somewhat less on rate hikes and a bit more on the balance sheet. That's going to determine whether inflation, it will all be determined by whether inflation comes down. So, Becky, the story here is they're leaning more on the balance sheet. And I think you heard that maybe from Esther George yesterday from Kansas City, who wants that course of action.
So you see, they're talking about more on the balance sheet and less on rate hikes. Okay. So now if they are more hawkish, okay? Hawkish means more aggressive. Dovish means more passive, like a dove, a bird, and a hawk just come in and tackle. So if they are more hawkish this year, and and become more aggressive this year, and the market sees that it's going to be less aggressive in 2023 and 2024, then actually the recovery will be sooner and the bear market will be shorter, because the market looks towards the future, right? And so you say, hey, why do they have to do this at all? It's like if your house is on fire, the firemen show up with axes and hoses. They gonna tell you, we gotta smash all your windows out. So that's the balance sheet, right? And then we're gonna flood your house with water. Okay, that's the rate hikes. But we're gonna save your house. You can always rebuild, right? And so think of the market that way. Think of it this way. The balance sheet and the rate hikes represents the water and the axe. They gonna smash your windows. They gonna flood your house with all this water, but they're gonna save the house, right? And so the rest of the house from burning. And so that's what's happening with the stock market, and that's why the Fed have to do what they're doing. Okay, now that doesn't even price in or put in, they were part of the problem. But what happens to the stock market is it starts to price this news in the sooner we know it. So I would rather for us to have more and aggressive rate hikes now so we can get out of this bear market. The average length of a bear market is about 3.5 months, right? And so this is actually good news to me looking out, because we know that we could buy through this bear market. We know that we can dip buy through this bear market and make money long term. All right. So I want everybody that's listening to me to look at the video that I'm going to leave here. And I believe it's called "Where Are We in This Market?" Boom, bubble, burst, bust, bull. All right. Because it will give you a clearer view of where we are and how you can make money in all of these plays. And everything that applies to stock also applies to crypto. All right, good people, listen, we gotta be trading right now. Make sure that you have the Webull link below. Download it from my link below. It does help the page out. Deposit $1. They're going to you can deposit 1 penny. They're going to give you 3 stock worth up to $3,300. And then for your crypto trading, I have Coinbase below. Download my link below, deposit $100, watch some videos. They're going to give you some free Bitcoin. All right, good people, I got to go take care of this tooth. I will see you later, all right? I love you guys. Live, love, laugh, and learn.